So there's a lot here. I think I have 66 slides. I may or may not hit them all. I also have a workbook, so we may shift and go. So, roll your shoulders out, take a breath, set your phone aside, engage. There's going to be a wealth of information here, hopefully not too much. But just to warn you, this won't be a slow one. So we can skip through that. The key things that we're going to be doing here is hopefully boosting your confidence when it comes to financial discussions that you will be having with angel investors. I want to help you learn some key financial terms and concepts. And then I want you to think about pricing models, because no matter where you are today, thinking through a revenue projection is an important task. Even if you're not going to have revenues for a few years, the investors are going to want to know that you're thinking through those things. So the sooner that you can start thinking about different aspects of pricing models, and your pricing model will never be done. It's always going to be evolving. So the sooner we can get that discussion going, the better. I'm going to cover, so these are some of the terms that angel investors will be asking you about. I will be covering these. So I won't dive into them yet because I'll cover them in the general conversation here. I'm going to start with financial statements. So they are boring sheets of paper with a lot of numbers. They make people gloss over. I'm going to try to help you understand each of those. So we have the
before you get into that, Susan, why you were going to ask the question, right?
Yes.
And how confident are you in this room in terms of your financial literacy? And maybe we could just do a quick poll with hands. How many of you feel very confident in financial literacy? Okay. How many, somewhat confident? Okay, good. And not confident at all would be, who's left. Okay, good. Okay. It just helps us understand what level you're at.
And Julia, unfortunately, I wasn't able to see all faces there. So how we have an even.
You had about, I'd say 3 that were very confident, and then a fairly big split. The rest were divided between somewhat confident and not confident.
Awesome. That's
okay.
Pretty normal. That's fantastic.
Yes,
okay.
It is pretty normal.
And so let's just see how you feel at the end of the presentation. So we'll see if we can move that measuring stick a little bit. So I'm going to start with the 3 financial statements that are core. When people say, send me your financials, they're talking about an income statement, a balance sheet, and a statement of cash flow. And they actually all tie together. And so in the income statement is where you're showing your revenues and expenses. And so the revenues is the amount you're taking in from customers. Your expenses are all the money that that's going out the door on payroll and other operating expenses. And the difference between those is profit. And profit is a generic word. It's also referred to, there's gross profit, there's net profit, there's EBITDA, all those things. We'll kind of cover those. In general, what you're looking to do is see that over time, you're going to be profitable. Businesses exist to be profitable eventually. In the early stages, especially in an innovative type business, you're not going to see that right away, but you want to know when you're going to be profitable. So the first statement is the income statement. The thing about an income statement is that it's performative. It's like how you drive your car, like going 30 is what? 30 kilometers, that's a distance, that's a speed per hour. The P&L is like that. It's time-based. So when you're looking at an income statement, you could be there's a start and an end. So so if it was an annual statement, and let's say your full year was a calendar year, then it would start January 1st and it would run to December 31st. That is the period of time that you're looking at. It could also be monthly.
Okay, we lost Susan. Give her a second. And I'm going to do another poll. So what's the most challenging financial concept or metric you've encountered with your business to date? Susan, I just did a poll because I was just filling time for you.
Yeah.
You fell off the map for a second.
I hope that doesn't happen again. That's not happening.
I know. We'll see. But so the poll is, I just like to see, and you can throw it in chat or you can come off mute. what is the most challenging financial concept you and your business has already hit to date? Bronwyn?
Gonna say I'll come off mute and say because it's faster than typing. But I think pricing is definitely, I see that in the chat from Dallas. Pricing is definitely a number one, especially with that. I liked how at the beginning, Susan, you said the strategic pricing models, because I hate saying it depends when we talk to investors, but it truly does depend if we're talking to a hospital or a small clinic. And so talking about that. But also the projections, and I see that just came out too. But the projections and that it's basically, you know, made up to an extent, but then there has to be backing behind it. And so how do you find the right backing to, you know, make up the future in hopes that you can hit a realistic number, but also be high enough that it's intriguing as well for those who are looking at the company.
Well said. Well said. Yeah. Stephanie's going and saying, knowing how much it's going to cost to execute later when we scale, it's really hard to figure out.
Yeah.
A lot of assumptions, a lot of estimates come into play. Okay.
Absolutely. Am I back? Are you guys able to hear me now?
Yeah, you're back pretty well. And you know, the chat has got some comments going, all great comments. Runway is a moving target. How much runway you have, knowing your burn rate, that's going to come up in a little bit as well. So good. It's good to see where you feel free to keep adding, and I'll give you back to Susan.
Excellent. Thanks, Julia. And thank you, everybody. We'll hopefully that doesn't happen again. I'm not sure what happened there, but we'll keep going. And so the key thing about the income statement is it's a start and end time. So it's like driving your car. It's performative. As opposed to the balance sheet, which is going to be a snapshot in time, and I'll talk about in a minute. So here I'm just showing you a standard P&L. You're going to see the income or revenue at the top. Cost of goods sold, that's what COGS stands for. It's your variable costs. And then the difference between the two is the gross margin. And then you have your operating expenses, which lead to the difference between those two is your operating income. And then you tend to have like other income, which would be an interest income if you had money in the bank and it was accumulating some interest, or you receive some grants, they would go into other income. So it means income other than from customers. Other expenses, same kind of thing. They're sort of extraordinary type things. Could be depreciation, could be financing charges, but they tend to be things that are not operational in your business. There's a little out of the ordinary. And that gets you to your net income. And then the difference between net income and EBITDA stands for earnings before interest, taxes, depreciation, is those things that I just said it stands before: interest, taxes, depreciation. So your EBITDA is generally going to be a higher number than your net income. We'll cover that again in a bit, but I just wanted to, walk you through one view. The P&L is going to look first of all, a P&L is not actually regulated, so it's a bit artistic how it gets constructed. So there'll be some variances when you're working with a CFO and how they present it.
Good question on the chat. I'm just gonna interrupt. So how is income from the investors accounted for in the P&L? Is this
Okay, thank you. Great question. So if an investor gives you money, they're actually not giving you income. They're doing an investment. So if it's let's call it a safe, or if it's something where you're deciding your terms later on, it's a form of debt. So that money would comes into cash. And then you now owe the investor that amount back. So usually there's a term. So if there's kind of two factors. One would be there'd be an end term. If an event didn't happen, you probably owe the money back. If it's a convertible
note. Yeah.
Yep. And then if it converts, otherwise what tends to happen is it sits there until you've done a larger raise. Let's maybe when you do 3 million raise, everything converts into equity. And so then it would go from debt into equity. So it never hits your income statement. The income statement is reserved for money that your business is generating. What the investors gave you was capital to fuel your business, but they're actually not giving you operational income. That is reserved for your customers giving you money. And if you earn a grant is a non-repayable source of money. So when IRAP gives you money, perhaps for some technology spend, that would go on your income statement. Anything that you're going to have to pay back, so a bank loan to BDC, perhaps like a startup bank loan, that's going to hit your balance sheet, doesn't hit your income statement.
But a safe is different than a convertible note, right, Susan?
They are, and I don't go into that too much here because the thing is, the names no longer are clear anymore because a safe used to be a simple form of transaction, and now they're becoming so customized that you really have to kind of look through the terms of it. But in general, when money comes from an investor, it's going to be either showing up as typically a long-term debt on your balance sheet or as equity on your balance sheet. But in neither situation is it hitting your income statement. Okay. And the thing with an income statement, it is like that performance vehicle. So we compare timeframes. An income statement on its own is not nearly as meaningful as it is in comparison to something. So you're either comparing to last year. So here you're looking at a company that did $1 million in revenue in 2024. In 2023, it did 158,000 less in revenue. So they had a 17% increase. That's the kind of information you're going to get from financial statements, and that there's going to be in this case, it's a year-over-year comparison. In this case, we're looking at a monthly trend. We're looking at the performance in October, November, December, January. You can start to see, the revenue coming in here in this company is a little lumpy. We get 69,000 in October, it goes up to 180, then 100. You're starting to get a little more information about the business by looking at the performance month over month. That's a common structure for an income statement. The key thing about the income statement is there's something in accounting called the matching principle. And so what you want to be doing is matching the revenues for the respective spend period. And where this really shows up the most for startups is if you had, let's say, a license that you were selling, and let's say it was $120,000, a customer is going to pay you for access to your software for 12 months, and they're going to pay it all up front. So you receive $120,000 in that particular month, and that's it. That license is giving them 12 months of access. The revenue for that period is actually 1/12 of the 120. So it'd be $10,000 that you would recognize in that 1 month, and then the next month, and then the next month. So it gets spread over a timeline. So the key thing about the income statement is that it's intended to represent the performance of the company in that period. And sometimes you then need accounting support. Generally, even bookkeepers will be recording your transaction, but the next level up, controller kind of level, is ensuring that you will have the matching principle. And investors are going to want to see the matching principle applied to your income statement. Alternatively, what they see is people recording at a cash basis. Cash basis means it's when you receive the money. That's when you're showing that you're recognizing it as revenue, and there is a difference. Questions about that one? You might have specifics in your businesses that would be helpful for us to spotlight here.
Ron has a question. Yeah.
I was going to say, I have a question. I was going to type it and I was like, it'll take too long again. So I'm just going to, and I don't know where the raise hand function is on these workshop. I don't know if it's possible. So apologies. Yes. I guess question is we've been working, same thing. We have a controller in-house, but we have been working outside with like a fractional CFO group. And one point that we can, I think, never come to agreement on is the grants. And an example of this is NRC, for example, approves a project for, let's say, $200,000 at a certain date. We put it in right now on that as a receivable because we know that by the time that the end of the project comes, by this date, we would get paid out the whole thing. But our claims vary every month. And so it was helpful when we do projections to say we know that we have this much cash coming in until said date. But working with them, they said that was confusing and they couldn't do it that way. And the accounts receivable was messing up the whole financial sheet. But then when they don't put it in, it looks like we have no money. And so I just wonder if you have a solution on how to really approach that better as we go forward, because we want to show that we're not going under the red as quick as it looks like without that in there.
Okay, perfect example for us to be able to speak through. So the first thing is if there's a grant like this coming in, so let's say I'll use my 120,000 example again. IRAP NRC approves you for $120,000. It's for costs that will be incurred. In order to get that approval, you had to submit a projection that indicated how much you were spending. They're likely giving you either 50% or 80% of your cost, and you're incurring the rest. And so as you're incurring that cost and submitting your claim, that would be the appropriate time to recognize that. So as you submit the claim, you'll record the other income for the amount that you submitted, and it goes to other receivables. Not quite an accounts receivable, that is specifically reserved for customers, but it would be an other receivable. It's still a short-term receivable on your balance sheet. And then when the money hits your bank account a week or two later, then you would record that as cash and offset the accounts receivable. But you wouldn't record the 120,000 upon approval. So approval doesn't really matter. It's the same thing with customers. If you sign a 3-year deal for a customer, let's say they're going to give you $120,000 a year for the next 3 years. So we got a $360,000 contract that's signed. And then we say we can invoice them $120,000 upon signing for year one. So we sign the $360,000, that doesn't go into your financial statements anywhere. You invoice for the 120, you now have accounts receivable for 120, and the amount goes to deferred revenue, which is actually a liability on your income on your balance sheet. And then every month you're going to recognize 10,000 of that. So future-based agreements are not recorded on your financial statements unless there's an exchange of cash. It really is money moving around. And so how that would be represented, however, is in your projections. So you know you're going to get the $120,000 from IRAP. So when you project out your revenues and your expenses, you're also going to project out the money that you anticipate coming in from IRAP. And that's how you show the investors that, yeah, we've got costs, but we've got offsets for that as well. We don't entirely need your investment to cover everything. We have maybe some customer revenue, some grant revenue, and then we're expected to receive more money from investors. That's in your projections, future-based statements. Does that answer the question?
Yeah, and then I just guess one follow-on to it is then internally, the reason that we have it in the receivables is to know how much we actually have left to spend with them, because there's not really another necessary way to track it in real time since it's delayed reimbursement. And so then in-house, without being like a paper and pen writing it down, you know, how do we then keep track of that internally in the software?
That cash flow, Susan? Yeah.
Exactly. So I mean, a projection is a good idea. So every business, especially one where you're dependent on investors and you want to know your path to profitability and you want to know what your runway is, you need that projection. Use Excel. Excel is G Sheets too, but Excel is arguably better when you try to download your G Sheet to give it to an investor who's asked it in Excel. There's still breaks that happen. They're not quite in its sync, but a spreadsheet software to put your forecast in, that's how you're going to know. That's where we want you making business decisions from, is looking at, you set the plan. So you're setting, here's our spend plan. Here's when we anticipate the revenues, the investment coming in. There's our cash on the bottom. There'll be a cash flow adjustment. So you're going to have a statement, especially since you're working with a CFO. CFO should have projections for you. And that's what you're making your business decisions from. And each month you're also checking to see how are we doing between our budget and our actuals. And if there's starting to become a big difference, you want to refresh that. And that's what's called a forecast. So the budget is the thing you set for, or the plan, something that you kind of set, and it's going to stay at least for a year. The forecast is as you go and life is different than what you planned for, you're refreshing elements of it. So you always have a sense of what's our runway. And our runway means in what month are we going to be out of money? That's the thing that you're always looking for. So you're having it in there and you'll be looking at, that's the document you most want to be looking at to manage your business.
Yeah, and I'd love to maybe bring that worksheet up maybe
Okay.
not right now. We can come back to this, but so you can see the visual of the revenues and expenses. It's a good
Yes.
explanation of all this. Maybe
Good
we
idea.
could, yeah, a little bit later, but it's a great visual. But a good question, Bronwyn. Thank you. Okay, balance sheet next. Okay.
Yeah, we're going to move right to the balance sheet because I said the other one was performative, like driving your car and you go miles per hour, kilometers per hour. The balance sheet is a snapshot. It's a photo, and it's basically showing your assets, liabilities, and equities. And so if you're having, the visual for a balance sheet, you often have the assets on the left and the liabilities on the right. The key thing, assets are what's in your bank. What's in your accounts receivable? Accounts receivable means you sent an invoice to your customer, you met the terms of, you've earned the revenue, you've billed the customer, but the customer hasn't paid you yet. So it's going to be liquid. You might also have something that you prepaid for. The current assets are essentially anything that's going to be coming in within 12 months. Long-term assets are things that you can liquidate over the long haul. So equipment, a building, when you buy those sorts of things, they show up on your balance sheet as an asset, as a long-term. All your assets are totaled together. Then you have your liabilities. That's who you owe. So if you have a credit card accumulation, if you have HST building up because you're charging your customers more than what you're paying out. If you have bills coming in, you get a legal bill, you receive the bill, but you haven't paid it yet. All of that activity is a short-term liability. The long-term liabilities is everything that you owe greater than 12 months from now. So if you get a 3-year loan from BDC, you got to pay them back in 3 years. That would be a long-term liability. And there's different ratios as you get to, a sustainable level, let's say break even, EBITDA positive, no longer having a net loss, then lenders especially will be looking at your balance sheet to determine how healthy you are. So if you have more money owed to you than money you owe, that creates the differential between the two of those is equity. And that's the third piece. So your assets minus your liabilities equals your equity. The balance sheet, that's why they call it a balance sheet, because that is the rule, that you can't have assets greater than your liabilities and equity. Okay? Questions on the balance sheet? Has anybody looked at their balance sheet? It's ignored. It tends to be the most ignored document. People are, because they spend less time in it, they tend to be, less confident in the balance sheet, but really it's a photo. And so when you have a balance sheet, it's at that, you'll see at the top, as at December 31st, 2023, that's that particular day. So unlike the income statement, which will show a start date and an end date, the balance sheet is just a snapshot in that moment in time. And if
Can
you
you
think
move on to your visual, Susan? I like that, just for the Small Business Inc. balance sheet.
Do I have one here? Let's see.
Yeah,
Oh,
you have one. Yeah. It's a good visual. And about half the people said yes, they've looked at their balance sheet.
Okay, that's pretty good.
Yeah.
That's pretty good. So if you see here, you'll see what I'm talking about, that the current assets and current liabilities, those are all things you owe within 12 months. Long-term assets are things you could liquefy, but not quickly. And long-term liabilities are debts that you owe, but not anytime soon. It's going to be out in the future. So if a customer paid you for 3 years of your software license, if that's what you're selling, 1 year's worth of that would be in current deferred revenue, and the 2 years remaining would go into long-term. So the balance sheet if you're just using a bookkeeper, your balance sheet may need to be cleaned up, because bookkeepers tend to not have as much knowledge on the balance sheet. If you're using a controller, the controller should be looking at your balance sheet. If you have a CFO, for sure, they're ensuring that this is an area that an investor, when they go through due diligence, they want to know that what's on here is actually correct. So that's one of the keys. So it's not performative, but it's important to know, to understand what's there, so you feel confident and don't feel super nervous when somebody starts to ask you questions.
And when we say, your financial statements need to be in the data room. This includes the profit and loss and the balance sheet. And for your last fiscal year, at a minimum, and potentially for the last quarters.
That's right.
Yeah.
That's right. So typically we'd have, so every year you want a public accounting firm to be presenting you with your financial statements. There's 3 levels of statements. There's compilation engagement, which is essentially taking if you're using QuickBooks, they're going to take your QuickBooks data and they're going to put it all on pretty letterhead. And then that makes it look official. They don't make too many changes. Review engagement and audit, the more money you raise, the more you have to go through this tighter scrutiny. And then there's a lot more activity that kind of happens to make sure that what is listed in each of these accounts. Like if you see here, accounts payable, you'd be asked, what's in there? Who is it that you owe? And how long has it been outstanding? These show different. So for instance, if I was to say accounts receivable, that's the amount you're expecting from clients. They may say, can you send me an aging accounts receivable? That indicates how long that's been outstanding. If a customer hasn't paid you within 90 days, then there's going to be a flag on, is it collectible? Or does it have to be written off? So that's the kind of information you get on a balance sheet. Questions on the balance sheet?
Dallas asked the question, what kind of questions would I get about the balance sheet? And I think Susan just answered them. Certainly, investor would look at that long-term debt and start asking questions about, what it consisted of, is the great example Susan just gave. So if you have further questions, Dallas, let us know.
And thank you, Julia, because you're right. Investors will be probably focused on the long-term liabilities. They want to know who else you owe money to. If they're putting money into the company, who has to be paid out first before they're going to get their return. And so they'll look at a starting point of who do you owe? Okay. And then we got the cash flow statement, and it's essentially just talking about cash. It shows what your starting cash flow balance is and where your money went. And there is a cash flow statement as part of the financial statements, which on its own is pretty tricky to understand and will not give you any value as a business owner. So there's no point looking at that on a regular basis. But creating a cash flow projection is really important. Obviously, you want to know when you're going to be out of cash. So there's sort of the formal cash flow statement that goes as part of your financial package. If you look at last year's financials and you take a peek at that, you're like, yeah, okay, I don't know what it's telling me about my business other than where money went. But on a go forward basis, you want to be able to demonstrate to investors where the cash is going.
And this is the question about runway. This is the perfect answer. Is if you have your cash flow projections, you should be able to constantly adjust for, additional revenue versus lower or higher expenses, and see that how much runway you've got left at any moment, really.
Exactly. And like, an investor, if they're looking at your projections, they're looking to see when is that number go positive. So when is the inflows greater than the outflows? So they give you $500,000, your cash is now dropping typically. Typically they are giving you money so that you can spend money on something. So you're going to go into a net loss. You're going to spend more than you're taking in, but they're looking to see when is it projected to break even. That is very important these days. And they generally want to see that you're, depending on the business model, there are some med tech type companies where you're going to be years away. Otherwise, within 2 years, you want to be able to demonstrate that you're ideally before you run out of cash again, but within a 2-year time frame. So you need to be thinking about that. When are my revenues going to exceed the expenses that I have to take?
Yeah. And I when I was president of ChipWorks, during tough times, we would look at the cash flow projections weekly, and during good times, we'd look at it monthly, because it was always important to be on top of that. So it's a key operational tool for you going forward as well.
It's so true, Julia. And ideally, like being a virtual CFO, I really want businesses to have enough cash so that they can just look at it monthly rather than weekly, because it's the same process for your finance team to do. Every time they refresh the cash flow projection, it's the same amount of activity. So it's to do it weekly is 4 times more expensive from a resourcing standpoint as to do it monthly. And in the accounting department, everything works on a monthly cadence. So bank reconciliations are going to happen monthly. There's a natural rhythm in an accounting department that's a monthly basis. So ideally, you have enough cash in the bank so you can just refresh on a monthly basis. But sometimes we're not. Sometimes, we're in day-to-day cash flow when it's tight. I won't make you raise your hand if you've experienced that, but I certainly know that some of us have been there. That's right. And so when it comes to, now we know about our income statement, balance sheet, cash flow. So you can send your financials off to the investors. The next thing that they want to know is what's your financial story? So where's the growth and potential? And where are you going to invest the money? Those are the key things that you'll need to talk about before you even have it enumerated. Like, so before you have the spreadsheet completed, be comfortable talking it through because the communication of it is really compelling. However, a lot of people, in order to have confidence talking it through, they really have to see the numbers. So it kind of comes down to your style and whether you can talk the talk before seeing the numbers. I'm a type of person where I like to see it all written down. That builds my confidence. I see the numbers. This can work. All these assumptions make sense. Now I can talk confidently about it. This is what we're planning, and I can answer questions about it. So this is what we're looking for in our financial projections. Typically, it's 12 to 36 months. So I would recommend doing 36 months because before you know it, 6 months has gone by and then you're less and you're having to add another year. So a lot of things like IRAP is typically 2 years. A BDC startup loan is typically 2 years. Sometimes they say 3 years, but you can get away with 2 years. So sometimes people will ask you for a 2-year, especially if you're super early. Obviously, the further you go out, the less reliable the numbers are. You're just throwing more and more assumptions. It's going to go different than planned, but you do want to have to demonstrate that you've thought it through, especially from a growth standpoint. And that future potential is what the investors are looking for. So it doesn't matter that you haven't made money yet. That is understandable. You're early in this development. So the emphasis, it's like, there's no shame in where you've been. It's here's where I am. This is where we're going. You in? You believe me? You buying this Kool-Aid? We drinking it together? That's what we're going for.
So I'd like to ask the question, how many people have heard the saying that women entrepreneurs are more conservative in their projections than men? I think everybody? Yeah, okay. And yes, Dallas, you want to throw something in? You put your hand up, Dallas? No. Okay.
Oh no, sorry, that was fully an accident.
Oh, okay. That's good. Okay. So it is true, and I think the biggest thing I've learned, and mainly through SheBoot and doing these sessions, is the more women can do the build and spend the time doing the build year over year, based on, and I think we're going to come back to that with the pricing strategy a little bit too, Susan. Yes, so something to look forward to later on in this session. But the better they can be in projecting their confidence in their numbers and being able to explain them to investors. Also, taking into account that there's, as Susan said, as you go further out, more and more assumptions, estimates need to be brought into factor. And it is, if you think it through and speak it out loud to somebody, the easier it's going to get to do that explanation going forward as well.
Absolutely.
Our goal is to help you raise your confidence in talking through your numbers.
And you're helping me just sort of blast right through to a couple of key things to be thinking through in that. So, I mean, first of all, I mentioned it here somewhere in the deck about doubling and tripling. Those are the kinds of numbers we want to see year over year. Doubling your revenue, not 10 or 20% increase. You're starting from a small base. You got to go big, go big. Get to $1 million in revenue as quickly as possible, and then be doubling and tripling. That's the kind of numbers that we got to breathe our way through. Okay. And for some people, that's easy. You're already thinking 100 million. For other people, it's like, well, we're conservative. It makes us great business owners. We're prudent. So we want to be bold. Then the key things are, in order to be bold, what's our customer acquisition cost? What is our strategy to acquire customers? This is a key metric, CAC. What's the lifetime value of the customer? Lifetime value is how much money you're going to make from the customer over the entire life of the customer. How long is a customer with you? If you have a subscription-based model, there's formulas that will help you determine that. You don't know yet. If you envision a customer staying with you for 4 years, but you've only been in business for 2, how do you possibly demonstrate that? Well, there's ways to model that out and to determine that if you have any customer data at all. And if not, then we're setting some best practices.
So Cheryl's asking the question, we're unsure right now how to calculate it. And are we going to go into that?
Yeah.
Yeah.
Yep, we will.
Okay. So a little bit later, Cheryl.
Exactly. Stay tuned. We'll work our way up to it. And so first, let's talk about burn rate and runway, because these are the hottest topics for you right now at this stage in the business. Your burn rate is how much money you are going through every month. Technically, it's not a formal metric in the sense that everybody calculates it the same way. Sometimes investors mean how much is your cash dropping each month? Let's say every month you're dropping by $50,000. That's one way of saying your burn rate. Another way, sometimes from a metrics, like, it's fair to ask the investor, how do you calculate it? Especially if it's an institutional investor, because they'll have an institutional way. And in their situation, it's probably your expenses, your total expenses, minus the revenues that you receive from the customer. So it's close to EBITDA. So how much you're spending. If I'm spending $50,000 a month and I'm taking in 10,000 from my customers, I'm burning 40,000. That's what you want to be comfortable. You want to think about that number, and throughout the SheBoot program, I'm available. Other financial advisors are available to help you get confident in what that burn rate number is. And you may want to be strategic about it too. Runway is how much time you have before you're out of cash. And typically, if you have let's say you have $1 million in the bank and you're burning $100,000 a month, you've got 10 months runway. $1 million in your bank account today, burn rate 100,000, 10 is your runway. So that's a mathematical way of saying runway, but from a practical standpoint, you may know that you're going to get a big lump sum from a customer in 5 months, and that you have an IRAP project that you think you're going to get in 3. So that all these things that are in the future will push out your runway date, which is why you want to have those projections, because otherwise your default is your cash today divided by your burn rate. Okay. Essentially, under that little piggy bank thing, it points out the investors care about how long you can survive without additional funding. They're going to say 18 to 24 months. They may say 24 to 36 months. It has increased since COVID. And after the US election, it may go back a little bit. It's weird. These are economic factors that tend to influence VCs, which then often influence angels. But today, I would say you want to go with 24 months. You want to ask for enough cash to have enough runway to get through 24 months.
Agreed.
Question?
And I'm going to suggest that we take a break, just 5 minutes for now, Susan. It seems like a good spot, or do you agree?
I'm totally cool with that.
Yeah.
Everybody, it's lunchtime, so if you want to grab some lunch, feel free to eat during this session. I don't want anyone falling asleep. Maybe just go on off camera while eating if
You?
And stretch. Feel free to stand up too to watch it. I just want people to be comfortable. Okay, how long are we taking, Julia? What do you
We'll
think?
take 5 minutes and I can time it. So when you
Awesome.
hear the annoying alarm, that's when we're getting started. We're going to dive right back in. So quick 5 minutes. I've got it set here and I'm hitting click.
Thank
Yeah,
you.
So 5
Yeah,
minutes.
all right,
Thanks, guys.
yeah.
Awesome.
All good, Susan? Yeah.
Yeah, I'm just gonna check to make sure that I do want to make sure I get all the material through, but I think it's good to get. So far so good on my side. You let me know.
Yeah. I think you know the visual. I'm of the maybe not all of your worksheet, but you know
Yeah.
I like that idea of reinforcing that spreadsheet with that visual. It surprised me in the past how many people hadn't seen that before.
Yeah. Yeah.
So it's
Yeah.
good for
I will go through that and I'll just talk through, because even if it's not specific to people's their specific
Yeah.
business, the concepts that are in there are helpful. Yeah.
When do you think you want to introduce that then?
Good question.
Yeah.
Where's
Yeah, I'm just kind of,
my-
because it might, whether it's either in the pricing or it might be next, right? Because you're talking about creating realistic revenue projections.
Once we go there, it might be hard to come back.
Yeah,
So
okay.
we might want to just earmark it to make sure we have 30 minutes for it. So maybe it's more.
So, yeah, so let's at least do it.
Yes,
Okay.
great.
So I think what I'm going to do is I just moved ahead a little bit because we kind of covered some of those slides in our conversation, and then some of them I kind of revisit the terms later. So I think we'll use this fresh segment for pricing variables. And before we talk pricing, I just want to get a sense of this concept of what investors are looking for in return, and just open everybody's mind to the fact that there's this, you might have heard of 10x, 10 times what they put in. If they put in $1 million, then 10x would be 10 million. So you have to be thinking through, how is a business valuation going to grow by 10x in 5 to 7 years? These metrics kind of change a little bit over time, but really that's the vision to hold in your mind. And it's not because they expect 10x on every, because some they'll get 5x return, some they'll get 1x, and some they'll get nothing. So overall, it really gives an angel investor on average a 2.3x. But you don't come in at that's not going to wow an investor, because their portfolio is very high risk. This is a high risk bet they're placing on us. And so we have to envision a company large enough to give them that 10x return. Okay. And in order to hit that, then you have to think lofty in terms of revenue growth. And so this was a principle that came out of, somebody's brain, to T2D3, triple, triple, double, double, double. And I mentioned it earlier, when you get to 1 million or 2 million in annualized revenue, then you want to be able to demonstrate that you can go from 2 million to the next year being 6 million, to the next year being 18, 36, 72. So you can see a path to 100 million in that fast a timeline. Does this always happen? Absolutely not. Like, what percentage of businesses really actually achieve this? I think, clearly less than 5%. But the plan has to be that's how we have to be envisioning this. We have to be stacking the odds in our favor of hitting these numbers. Questions around this? They've already bought into creating $100 million company.
Dallas has a question. Go ahead, Dallas. I can't hear you, Dallas. You're not on mute.
That's weird.
Okay, I can hear you now. Okay.
Okay. All good. I'm wondering, so there's definitely a difference between how Canadian investors and American investors look at projections.
Yep.
And I've had conversations with both, and oftentimes our more, I guess you would say, ambitious projections are seen as just too unrealistic for Canadian investors. And then the same projections in the States are seen as not ambitious enough.
Yeah.
With the with this example and these sort of like guidelines and things
Yep.
to work towards, is this more of an American perspective or Canadian?
So, you know what there's a, what do you call that? When there's a paradox,
Mhm.
cognitive dissonance, I think is the term I'm looking for. The reality is you have to be bold, but you have to demonstrate that you've thought through the nuances that can actually achieve that boldness. So there's a difference between a top down and a bottom up kind of approach to revenue forecasting. And so if you have, I mean, I would encourage you to be bold. So shoot for the largest numbers you can wrap your head around. And then you have to think through, well, how am I going to do that? What is the strategy? What's the customer acquisition plan that I have? How many salespeople do I have closing how many deals at what price to what group of customers? You'll need those data points, and that's when you're able to convey. If you're just saying, well, I think, first of all, we all start with a big TAM, right? We have a huge TAM, the total addressable market that you can get. That's huge. That has to be big. So we were thinking, well, we'll get 2%, 10% of that big market. And so you do your hockey stick chart based on growing to that. Well, what are the activities that you're going to do in order to achieve that? That's where you earn the confidence of investors. And these numbers again start from 1 or 2 million in annual revenue. If you're not anywhere close to that, how are you getting there? So you still have to get yourself up to 1 million or 2 million in revenue. So you need both bold ambition and the tactical plan to get there. Does that help?
Yeah, I want to add to that a little bit. I mean, I think there's different types of investors, and Dallas, you've pointed that out. There is a difference between U.S. and Canadian. As an angel investor, I want to see you potentially do a Series A. Now, you might not be the type of business that you want to do a Series A, let me point out. So there are differences between that. And that's actually one of the reasons why SheBoot uses a convertible note, to allow you to not be forced into kind of that growth through Series A, Series B, etc. But I would, in order to get into a VC for your Series A, if you're going that route, yes, you need at least $1 million annual revenue, probably 2, and you to go through those stages. There are exceptions to that. You'll always hear about exceptions to that. Maybe you're just so revolutionarily wonderful med tech, changing the world, and you don't have any revenues yet. It's possible, but it's not probable as well. Anyways, just to add a little bit more to that, Sakina has a question too. Sakina?
Hi there.
Hi.
Thank you for explaining. This is really shedding light into a lot of questions I've had. I quickly read the chat which Jane is asking, which is very similar to my question.
Yep, sorry, there it
So
is.
when you said 2 million revenue prediction, is it year 0, year 1? Because usually as life sciences company, like I'm in year 4 and it's only this year we started generating revenue. Like how do you reconcile that? Plus, like now that we are generating revenue, like do we then make the projections based off the revenue, or can we just be more ambitious and work towards it?
Yeah, excellent question. So I think there's a couple of things to keep in mind here. One is to raise money from angel investors, you don't need the detailed projections that show that you're going to hit 100 million in a certain amount of time. So you can raise money from angels with a solid product. They believe in you. You have a market. There's more qualitative factors in there than the quantitative ones to raise angel investor money. So first of all, I probably should have said that at the beginning. Don't feel overwhelmed as you're going to angels about all that you need. But here's the tricky part, is that the angels do want to know that when they put the money in, that there's a future for that. And so for a lot of you, that will require a Series A round. And in order to raise money, you need 6 to 12 months to do a Series A round. So they need to know that the money they're giving you will get you to that point. So that's kind of the consideration. So
Great.
what you're building now for angels isn't what you need necessarily for the Series A, but you need to be on your way. And you certainly need to be thinking about these elements now. And so that's one piece. The other piece is from a life sciences standpoint, the revenue, if you could be 3-5 years away from revenue, what tends to be pretty important in that structure is what are your compliance requirements? What are the regulations? There's a whole path there that unlocks the potential. It's not down to customers and revenue as much as it is in these other, B2B markets. But you'll want to be forming relationships with the strategic partners that you're going to have down the road to show that what you're building today is going to make its way out to the public, generating benefit, and has, in a lot of cases in that situation, it's an exit that happens versus continuing to grow and scale. You have to think through what is your exit strategy and how important is revenue to your exit strategy. Does that help?
Yeah, that's all good. And I'll stick with the medtech briefly here too, because I find, yes, you do have to project out further, and Jane, I am looking at your text as well too, and it is tricky to do pricing, but it's a good place to start, and you got to start somewhere. So, but the biggest question I always see when we look at the financial projections for a medtech company in an angel investor discussion is, did they leave enough time to get through whatever compliance they need to get through before they can take that product to market? Whether it's FDA, the medical class 2 device, whatever it is, usually the investors are looking to see, have they made the right assumption there, or are they trying to rush it through, and the dollars will be later. So looking at that, making sure you support whatever you put there in terms of timeline is important, and you can justify it, really. And a great way to justify that is to say, yes, well, we have our compliance person already. We're working with this partner, and this is the numbers they've given us. Okay.
Absolutely. Thank you for that, Julia. I'm building on that. I would say, this is where the strategy of different investors comes in as well, because you want ideally your investors to understand the business that you're in and what success looks like. And ideally, a lot of angels are people who had successful businesses that have exited and now are giving back, and they're giving back and creating a return for themselves, but they can help with those introductions to other strategic players as well. So it's a different path when it is when you're that far out from your revenues. But hopefully there's still value in thinking through these pricing variables. So they're critically important if your plan is to launch something, or you already launched something and you're now trying to increase your revenue. They're not completely irrelevant if you have a product that is a few years away from hitting the market and will be not a B2B kind of product. Okay. Okay, so should I, Julia, just jump in here, do you think?
Yeah, I think so. Yeah.
Oh, so let me talk through the variables, and there are a lot of them. And so
just pause quickly. Tally, you're still on the last topic? Yeah.
Yes, I think you might get into this. I just want to throw this out there. First of all, this has been so far very interesting. Thank you, Susan. All of it refreshing and just practical and new information for me. Something to throw out there, like the way that investors sort of need us to structure our revenues to show that we're going to scale and all that, I have found is often not in line with how customers want to be charged. This might be more of like a pricing issue that I have to deal with separately and figure that out. But I just find that it's like really, really difficult to make those two things sort of coexist.
But you've got a SaaS company, Tally, right?
Yeah, I do.
Yeah.
You've given me the excellent segue into
Okay.
this section.
Okay, fine.
I
I'll
think
let
it's
Susan take
incredible
over.
context, yeah, because this is the thing, is that if you don't tell your story, investors and anybody else you're pitching, they're going to apply a story to it. And always keep in mind, I think we learned a great thing at the SheBoot kickoff. The panel was so good. But I also loved how they said, you know, it's feedback that you're going to be getting. That's not a direction that you should take. You should take the feedback, give it consideration, and go forward with a plan that takes into consideration that you've received feedback, but it's your plan. So, and in some cases, people are, you know, ignorant. They may not understand your market. They may not understand what your vision is, but the more that you can put these details down and then tell them, the less they're going to they'll be less likely to influence you that way. So let me go through all the different variables, because there actually are a lot. And so, you know, starting with who you're building a product for and who's willing to buy your solution today. Sometimes we wait too long. We think it needs to be perfect. Sell whatever you've got, get it in people's hands sooner so that you can start to gather that feedback. Feedback does not mean that that's what you build out necessarily, but what are you hearing repeatedly? So obsess about that ideal client and what's the value that they're getting from the offering. And this is harder than you think. It sounds like very simple stuff. It is simple, but not easy. You have to kind of pay attention to the benefit of the benefit over time, because the more that they are receiving the value, the more you can leverage that value to drive up pricing. And so you have to really listen to the nuances. Are they saving time? Are they saving money? Those are two separate things. You don't necessarily want them to save both, because you're leaving money on the table. So which one is the one that you're saving at, just using those two variables to consider. So you want to be able to answer these questions for yourself. And you want to consider, you know, what is the metric on the price to be based on? And it's the kind of thing like they'll say, oh, this was really good. Can I have 7 more? What do you want the 7 more to be? Is it a per user? Like, I love this. I want my whole team to use it. I want this functionality. I want this functionality cascaded. What are the things that your customer could say, I want more of that? And each of those mores could be a price point. Keep that in mind. Thinking about how they're paying, how they're going to be paying you, and is it recurring? The more we have recurring, better. Recurring revenue is so valuable because often you just need to sell it the once. The cost of acquiring a customer is very different than activities to retain a customer. So if you have the opportunity to have a recurring revenue model, I highly encourage it. Sometimes that's not the case. Sometimes it's a one-time purchase. Sometimes it's a one-time purchase that can lead to recurring. But keep in mind, is this recurring? Can I make this recurring? Really challenge yourself to imagine, how can I make this recurring if it isn't today?
Well, I like to think of it as if it's recurring, you're making the math so easy for the investors. They're just like, they can look at what you got so far and they go, oh, if you add this many more, then, so they're just doing the math in their heads when it's recurring. It's easy.
It's easy. So, I mean,
Yeah.
investors are definitely going to have a heavy bias to recurring revenue models. And if you think about it, a customer pays you a certain amount this year. If you increase your price by 20% next year, they're paying you more, 20% more, without you having to acquire another customer. Without even any sales or marketing activity, you have now grown that revenue from the customer because it's recurring, because they're already in the door. So can't underemphasize the ability to generate. Your invoice cadence. You want to think that through. There's a lot of reasons. First of all, if a customer pays you for everything up front, yay, on a cash flow standpoint, but it might slow down the sale process. It depends. So sometimes it's easier to just throw something on a credit card and have it pay through, and there's a constant steady flow of cash coming in. Other situations, if you're doing a sale into a large corporation, an enterprise level sale is what they call that, then you're probably going through their procurement department. There's a lot of red tape involved in that. You're better off having a one-time purchase that happens with that. And you might even be getting them to pay for 3 years of your product or your solution up front once. So thinking through A, what kind of invoicing cadence do you want there to be? And B, what suits my ideal customer? How does it work for them? Because I've seen companies try to, oh, we'll just run it through credit cards, but credit card payment isn't necessarily the way businesses transact, especially large corporations. So thinking through that, that's an important variable in your overall revenue. And when I say revenue model, your cash coming in,
Yeah.
how you going to do your business.
Susan, just briefly, I'm going to let Sakina throw in a question here.
Absolutely.
Thank you, Julia and Susan. Maybe you cover this later on, but we went into market with, a pricing that was just based on research. And, the first time we priced our product, we had a B2B SaaS licensing. We just kind of drew a line in the sand. What is the strategy to kind of increase the pricing and cover that?
Excellent question. I don't actually cover it, so that's a great one. I'll happily speak to that right now. I tend to favor honoring those early customers with favorable pricing that lasts a long time. I think they've used the term grandfather, and I don't know where that term came from. It's probably not very appropriate for 2024. However, trying to get valuable customers that were early adopters of your product to pay what now you feel confident to charge new customers, there could be a gap. That's okay. So I would say the emphasis is more on A/B testing your new sales, and then secondarily looking at your original customers to decide, do I leave them as they are? Do I try to move them along into this new price point? There's such a gap usually between what a founder starts with at the beginning and what they're charging when they get more confident, that you may lose those early customers, and they may have been the heart and soul that helped you build out this solution, and they love you so much that they're referring other companies to you. So you're still reaping dividends from them, even if you're not taking more price from them. So I would say, don't let, I don't know how to get these guys to pay the new price, stop you from charging a new price to brand new customers.
Yeah. And Susan, I wanted to, I think there's another approach too that I kind of is in between, because you may start and get a certain price going. But another one I'd like to do as you get a little bit more mature is, and still really need new customers, is provide them with a large discount on a price. And that large discount actually says, this is what you will pay later on. But right now we want you to in trying it, and we're going to give you 75% off that price. It's while they're saying yes to that discounted price, they're also kind of saying yes to that future price. Not completely yes yet, but it allows you to increase it later on after they get through that initial period.
Yeah, so I think a lot of this is head work, right? Like, charge as much as you can before your voice starts to tilt upward. Like, when there's your litmus test, right? If you find your voice tilting, you're not there yet. There's a lot of mindset work in this. And so, yeah, you may have decided, you and your whoever you like to bounce these ideas off, you're boldly, I'm going to charge $10,000 for this. Then you get in the call and you start to sweat and you're like, so having tactics that help you at least say, yeah, it is $10,000, but right now there's a time limited difference. The key thing I would encourage though, is if you're going to give anything, any give, have a get, have a give and a get. So yeah, you can, what, I'm giving it to you for 5,000 if you pay up front. I'm giving it to you for something if you're willing to give a testimonial.
Testimonials are so valuable at that stage too. So yes.
Exactly.
Yeah.
So at least challenge yourself that I'm not just going to give this. I'm going to get a get in here. What's stuff that I want?
Great. There's a couple more questions. I'll take the first one maybe from Cheryl. Is it okay to use different pricing model for different client sizes? And yeah, you can make that work a bunch of different ways. You can make it work based on the number of employees in a corporation and set prices that scale as the corporation gets bigger. You can do it by their revenues, but you know what? It's hard to track people's revenues, especially with private companies. So, absolutely, it's a very common principle to use.
Yeah, I'm just
I'm wondering more like rather than like a different like price, like yeah, we have enterprise pricing where there's, if they're X
Yeah.
revenue, they are lower. But when like Susan, you were talking about the procurement, like we find that with our small to medium-sized businesses, it's a slam dunk. They agree to the terms right away. They're like we have a three-tier, like three-pronged model. So we have an onboarding fee, we have a monthly fee, and we have a percentage of revenue. And where we're struggling is converting the like larger corporations who are going through their procurement department and getting them to agree to those terms and that model. So it's more like on the actual model itself, like strategy there.
Yeah, so you definitely can have different different approaches, different pricing, and often if you'll see that on websites, right? Though if it's something for small that has both small and large customers, they'll have the details of on the website for the smaller business options, and then for enterprise, give us a call.
Yeah.
And a couple of things to take in mind: enterprise deals do take longer. There's a lot of time. There's a lot of more energy, phone calls you have to make. You probably have the legal agreements you have to review. So take money for that. Build that into your enterprise deal so that you are being paid for that investment. And be considerate. Chances are enterprise deals are the ones you eventually want to get to, but the approach to acquire enterprise customers is very different than your smaller business approach, and it's very different marketing activities. It's very different. It could be sale relationship based with channel. So you may want to tier those. So you may want to get so many of your smaller businesses first and reach a certain revenue milestone with them. And then in the meantime, you're sort of working on these channel relationships just as a founder, warming up relationships, but not actually hardcore selling there yet until your next fundraise. I find like having milestone lockers, like this is working for small business. Now we want to go enterprise, and we already have these relationships, is a nice, compelling story for an investor to give you more money. And then you're going to, launch your campaign for those enterprise, which is a different sale. And it may, your pricing may look different. That is totally fine. I think one of the things we want to have is sometimes again, there's so much mindset work here, feeling energetically clean about it. Feeling like, oh, there's nothing wrong here. For example, one I see all the time is the currency. You charge 1,000 Canadian and you start to have US customers and they're paying 1,000 US. Or what should you do? Do whatever you bloody well want. Charge US you can have separate prices for Canadian and US. You could charge it all basically in the home currency. But you'll just want to make sure that you're comfortable with that, we do that from the US because there are more regulations. They tend to ask more questions about data. We have to incur, maybe they're more aggressive, whatever it comes up for you on that. Get comfortable with it. It's all okay. It's all okay.
And there is an expectation, if you're talking to investors too, that if you're starting to do enterprise, that there is a 6 to 9 month timeline getting into major customers, right? So they are aware of those types of timelines. Tally, I can see your hand up, but Yobin, your question, if you have both monthly and annual subscriptions, do you use the matching principle to report the ARR as MRR and vice versa, or just label them as separate quantities?
Yeah, excellent question. So no, so I like the basic unit of SaaS to be MRR because that particular unit goes through a lot of the different formulas. And MRR times 12 is ARR. So they're both, ARR is what you would talk in terms like we've achieved ARR. If you're at, let's say, 10,000 MRR, then your ARR is 120,000. That's what you tell investors. We've achieved 120,000 ARR. Inside that, the payment frequency doesn't matter because you're using the matching principle as you've articulated to recognize the same amount of revenue. So whether a customer paid that for that upfront or whether they're paying you monthly, that's a payment issue. The revenue for it is, so if they're paying monthly in that given month, your monthly recurring revenue is the amount you're getting in that particular month. If they paid you annually, it's the annual divided by 12. That's the amount of MRR that you recognize.
Yeah, and I'm just going to add one more to this before I go to Tally, but only because the word booking is very different than revenue.
Yeah.
And so, let's use the example. If I had a new customer and booked 120,000 in terms of a new booking with that customer, that was a contract that went over a year, and it was a SaaS type product with, then I would take that and put $10,000 per month in revenue into that next year. So they're handled very differently, and I find confusion between bookings and revenue when I hear people talking, and sometimes investors get it wrong too, by the way. Okay.
Yeah, there's bookings, billings, and revenue, all three. Booking is the signed contract amount. So you might it might be a 3 million deal over 3 years.
Yes.
Billing is how much you're invoicing them, and then revenue is what is the total contract, like the value divided by the months that covers.
Okay, on to Tally, and then I think we'll move on for a little bit. Tally?
Yeah, as you can see, we're all very obsessed with pricing. I don't know,
Mhm.
it's like a challenging topic.
Yes.
One thing I don't know about how to deal with is whether to even post your pricing on your website, because I see a ton of SaaS products, especially in the legal tech sphere, where nobody puts their pricing up, and they'll literally have a pricing page with no numbers on it.
Yep.
Like, it's incredible. And then I actually had a call with one of the vendors that I'm sort of competing with, but I talked to them anyway, and I was like, why don't you guys put your pricing? And they're like, because we don't want anyone to know, we don't want our competitors to know our pricing, because then they're going to set their price that, next to ours, and it's all going to spiral out of control. But the customers hate it. I know the customers hate it because they have to jump through hoops to figure out pricing. So I don't, it's like mind-boggling for me, this whole situation.
Well, that's another great question. So I think, it's sort of a marketing one. If it's valuable to have your pricing visible, because your customer journey, they're getting comfortable buying from you by checking out your website, and having that there gets them comfortable. And then you're getting better value inbound calls, because they've already checked your pricing. They're good with it. Now they're calling. That's helpful in your selling process. It's a very effective. If just be ready for the fact that if it's published and somebody else is out there going $1 less than you, I think what you want to be stressing to the client is, we value transparency. We don't have time for foolishness. We're full disclosure. What you get, what you see is what you get. It's integrity to have that. A reason not to have it is because pricing will always be changing. And so if you're just getting comfortable testing things out, you may be changing what's on your website quite frequently. I've had clients like that where they're every second quarter they're refreshing what's on their website, and it was creating some confusion. But it's whatever you're comfortable with. Or certainly, I personally like to see the numbers before I make a phone call. I don't want to get locked in the process of being called a million times when I don't even have a sense of ballpark information.
You're kind of lucky in your industry that you have a choice. So in your legal tech industry, you now have a choice, but in other, more consumer-based things, that's not our way to work anymore, right? The prices are posted. Okay.
Yeah.
Right.
Yeah, in a lot of cases.
Yeah.
The more that it's the buyers hitting the website, the more like a consumer-based, you probably want it published.
Get going then, Privette.
Dive right in here. So the last point here is making sure that pricing model has, it does have an ability to produce increased revenue. Like if you're giving everything away in a one-time purchase and there's nothing to order more of, then it's trickier for you to, what's the basis for increasing prices next year? And you essentially want your customers to be paying more every year. And I'll highlight that in a metric shortly. And so, keeping in mind, here's just some prompting questions. How many users? What is it? Maybe increased features? What's your expectation of your customer over time? Sometimes you have these, like they call it land and expand, where you're getting into an organization and somebody's using it. They're going to love it. They're going to start sharing it with their friends and you want to get into other departments, if your product is something like that, just think through those. How is a customer going to pay me more and more over time? How are they getting more and more value? And how long are they going to stay? Is it a 2-month engagement with a customer, or is it they're with me 36 months? I think they'll never leave. Why would they ever leave? Think about what your product is.
And investors love that term, land and expand, because they can, again, they can do the multiplication in their head.
Exactly. And so I'm slipping in a little metric here for you, the lifetime. So in the lifetime value, inside the lifetime value calculation is lifetime. Lifetime is how long a customer stays with you. If you're a recurring revenue business and you are tracking MRR by customer, you then are able to track churn, which is basically the amount that you've lost from revenue in a given month from what you had before. So that would be your churn number. And that gives you, lifetime is 1 divided by your churn rate. So a 1% monthly churn equals 100 months. That's the simple math on that. So that's how you calculate the number of months lifetime is with your customers. So if any of you have MRR tracked by customer today and you're wondering how to calculate it, I'll happily work with you to show you that number. But I wanted to highlight that is how you calculate the lifetime. Okay. And keeping in mind, you want to be thinking, how long are customers going to stay with me? So I'm going to switch gears over to procurement process. I talked a little bit about it, but I'll just whip through these different variables. So if you're selling into an enterprise kind of situation, you want to know who are the players in the process. Often we're not talking to the decision maker. And what's new in the last 2-3 years is CFOs are now part of procurement process in a large company where they weren't before. So now you have to be in mind that, who's signing off on this? That's a question you want to ask early on. What are the steps to get to sign off? How does this company pay vendors ideally? Will they be paying annually or monthly? Getting this information sooner rather than later is helpful for your projections. Will there be a contract that I need to have that's separate from what I currently use? And how long will this whole procurement process take? So this is all information you're going to want to have, and why I often kind of encourage if your product or solution is going to be for smaller businesses and for large enterprises, then you may want to consider that tiering of that, so that because all of this information you have to gather and start to work on those relationships sooner rather than later. Other variables to take into consideration with your price is what level of customer service you have to give in order to keep your customers engaged, happy with you for the long haul. So do you have to give them any kind of 24/7 access or support? Is there anything you need to be monitoring to ensure that everybody's happy? Do you need to actively reach out to them? Do you plan to actively reach out to them? And do you need to are you in a, compliance security type sensitive information where as you start to grow, especially as you're selling into enterprise, you now have to meet all these different security standards. So what kind of investments are you going to need to make for these markets that you're selling into? And you're going to need to take price to cover that. So it's not just we built the product and the solution, or we're selling something manufactured and at 2x the price. You want to take into consideration all these support costs that are to be, you need some money to cover those too. So keeping that in mind. A couple of different pricing strategies. So there's competitor-based pricing. So we talked about, the website. So like, where do you want to be at, above or below in the competition? Often startups start at the bottom. They're like, well, we're like them, only cheaper. Cheaper is a tricky a pricing strategy to sustain. You can start that way, but you'll want to be evolving beyond that at certain points. Penetration pricing strategy is, grabbing, you're going in dramatically lower to grab the market share. And this can lead to higher churn when you actually have to do the price increase that I mentioned in order to reach sustainability. And cost plus pricing. So often in a manufactured type situation, it's like, well, there's these things in the market are really expensive. We can make them cheaper. So we're going to make them and just add 20%. Well, keeping in mind what you need to have from a markup standpoint in order to have a sustainable business. So these are different pricing strategies that can be kept in mind. And you'll want to have that sense. This isn't the kind of thing that an investor is going to ask about, but it's how you're going to form your pricing strategy so that you're able to defend against your prices and support them and know that you're charging enough to afford you to scale business. And so with any of these, you kind of need to know your costs. So you have to understand all the costs associated with producing, marketing, selling the product. You want to keep in mind that there's manufacturing overhead. If you're manufacturing something and selling it, often we can do those small batches earlier in a really scrappy way. It may even be getting leftovers. Like my business partner just made these beautiful planters from his leftover fence. They're gorgeous. Everybody wants them now. Like, how much could he possibly charge for those? Because he now needs to gather wood. So keeping in mind that as you grow and are successful, and let's say you get a deal with Costco, what kind of manufacturing costs are you going to have when you're at scale, and making sure that those are built into your early stage pricing.
Somebody asked earlier, how do you figure out, as you scale, what the prices will be or costs will be more correctly later on? And I think the answer is you have to make some pretty good assumptions and do your analysis in terms of talking to the vendors whenever you can about current and future costs.
Exactly. And I think, at a minimum, you got to be 2x. So what if your cost per unit is $100, you need to charge 200. People tend to this is where I think some of the profit margins get confused. Somebody might have heard a 20% profit margin is good for a company. That was referencing a 20% net profit. In order to hit a 20% net profit, how much gross profit do you need? Gross profit is your revenues minus the variable costs associated with those revenues. So you often need at least a 50%. So if your price is not double what your cost, if you're able to calculate your unit costs, if your price is not double that, then right away, probably too low. There are exceptions. There are I've seen super successful businesses based on a 5% margin because the volumes are so huge. That is feasible you can have a very profitable business down the road. But the question is, how did you get there? Then you really need the pricing model and the payment terms and everything in order to fund the business until it can be sustainable at those large margins. But to get there, you generally have to have a higher price point. And so that brings me to what's highlighted here. Value-based pricing is generally more profitable. So less of cost-based, you need to cover your costs, but building a model around cost structure, that's it takes a kind of a large scale. That's where you have the Walmarts of the world, huge volumes. Generally, as a business that's not that size, you want to be building your pricing model around the value that you're giving. So if you're saving people resources, your solution saves them from hiring people, then there's a value you can quantify. If it speeds something up, well, what are they doing with that increased time? If that the more you can quantify the value and let that be the primary pricing strategy, the more profitable generally you'll end up being. And that's a controversial statement. So ask me some questions about.
Well, I've got Tally asking a question right now, and feel free other people to jump in as well too.
Yeah, I just want to add 2 points. One point is that depending on how your customers operate, your cost might be dispersible to their customers. So that's something to keep in mind. The second thing I want to say is at least in my experience, people want to pay for good things. Like actually during this session, I got an email from a customer who we forgot to re-enable payment requirements for her account. She has been like one of those sort of early customers, and we turned it off for a few months. And she emailed me. She's like, I want you to bill me. Like, you need to be taking money at this point. So people want to pay
Yes.
for good things, and they feel uncomfortable getting freebies, especially if
Yes.
it's something valuable. I had no idea she was even in there. So just an example of,
It
Right.
is, it is true. Feel worthy because people want they feel better about paying. It's the same thing as if you get referrals and you compensate for that. So there's some schools that thought like, yeah, pay for referrals. They're valuable. But then some people will stop giving referrals because they feel like, oh, you only think I'm doing the referral to get the coupon or the promo or the gift card or whatever, and they'll stop doing it. It's a weird, there's a psychology involved
Really?
there.
I've never run into that. Yeah. Okay.
Yeah, it's a thing. So I would say it's absolutely charge. I'm gonna jump here into first the SaaS companies. Here are some models to consider. So pricing based on usage, which could be data usage. It could be a variety of usages depending on what your solution is. User base, the number of people tapping into it, could be tiered, small, medium, large, like premium, basic, a flat rate pricing. So regardless, this is what we charge. So sort of the one size fits all, which some of these, like the reason to do something like that might be, it's just easier to sell. And so your selling costs are lower. And then there's per feature pricing. So the amount of premium features that they're using, and how you can launch. And if you know your customer journey and they start and then quickly they want more, it's like, oh good, let's keep them wanting more and charge price for that. So these are some to consider with respect to your solution. Regardless, if you're not losing 20% of deals on price, you're charging too low. So I really encourage in the early days to add, you did 5 sales calls last week and you said $100. Next week, say 105. Just keep going until you notice where the grind is in your close ratio in general. And I've had clients, so I had this one comes to mind. Her business was struggling with profitability. And the first thing I was like, okay, your price is too low, increase your price by 20%. She instantly did it. She was I don't usually see people that without resistance, but she trusted that. She went out, she immediately increased her rates by 20%. It was a service-based business, and became profitable. And she had no pushback. She had no grind in her close ratio.
Yeah, that's great. And I'm going to suggest that maybe we pause for a couple minutes and skip this section, the channel pricing, right? Right, we were gonna maybe do the worksheet, and then I like the last section on metrics.
Sounds good.
Now, I just wanted to tell the story.
Oh, sorry, Julia.
I just wanted to tell the story of one founder who this was a workshop. They were charging $100 per attendee at a workshop. They gradually did this, and they got up to $500 before they finally stopped. So they went from a $100, it was a one-time payment, not recurring, but up to $500 easily. And they were just ecstatic with that. Dallas, you had a question?
Yeah, really quick on back to one of those pricing slides on like the user-based pricing. A question that I'm getting in my sales cycle, and I'm learning a ton during this sales cycle. And one of the questions that I get that I just really don't know how to answer, and maybe the reason why is because it's a technical question, but I will often get asked how many users that price allows, or how many users our platform can take for a certain price. And I'm not really sure how to approach that other than, I'm just not really sure how to approach that answer or to work it in based on users and what that price is.
Yeah, I think, users is often a great pricing lever. And so I think what they're trying to do, they're fishing to see, have you thought that through? And is it a tier base? So rather than it being per user fee, it could be, this license allows for 10 users. And then at that point, you jump up into the next level. They want to see that you're able to grow revenue. And so, think through that, the audience that you're selling to and what number of users you can scale up to. Sometimes you run into grind in the performance of the product at a certain volume. If you had 10,000 users at a time, it may not work as well. So it may be focused on 100 users or less, or maybe 10 users or less. Whatever you can do, often per user is a great metric. And I think they were probably projecting that in their question. They were looking for you to have thought that through.
It's worth a longer discussion too, Dallas, but I'm going to suggest, and how do people feel? Do they need another quick 5-minute break? And before we finish off, because we've got another 45 minutes ahead of us.
We
Everybody's
can
okay?
also just take 2. Why don't we just take 2 quick minutes?
2 quick
Everyone
minutes.
can look outside a window and stretch
Okay.
a little, at
2
least,
quick
maybe use
minutes.
the washroom.
Yeah.
Okay, 2 quick
Okay.
minutes. I'm going to time it now.
Sorry, Susan. I just
Appreciate
yeah.
it.
I do love the I was looking at the last section on metrics too for investors. Yeah. I thought maybe if we did this now and then came back to that.
So maybe we try to cap this to 15 minutes. Because it's just to give an overview, and then we'll see where the questions go. But I agree, the metrics are a goal. People need to hear in order to get a bit more familiar, a little more confident on.
We created a sort of overall glossary and for the SheBoot. I've been editing it as we speak with the ones that I'm missing from your list. So
good.
Yeah. No.
Thank you, Julia. I have that on my list of to-dos after this, so that's awesome. Thanks.
It's okay. It's a good one.
And did you hear back from Jennifer?
No, but
okay.
Yeah.
I was kind of waiting for that, but okay.
Yeah.
Okay.
I
verbalization around metrics too. Like it's tricky when you read them for people to like. There's definitions inside the metric definitions. Like the words need to be defined. It's like
Well, what caught me the other day is I don't know. I always MRR no problem, but ARR. I didn't realize it was recognizable revenue.
So yeah, it is. It's the same as MRR. It's like centimeter, decimeter, or meter.
Yeah,
like it's the same, but 12x of a monthly. But then I think people get confused because you hear ARR and they hear ARPA, and then there's ACV. So so average revenue per account is ARPA. So that gets confused with ARR, and ACV is annual contract value, which is not the same as ARR necessarily, because you may have one-time activities that you're charging for as well. So there's no doubt it's confusing, and it's easy too, it's simple, but repetition's required, and people understand. So it takes some time.
Well, I don't know, annual revenue versus ARR can be significantly different.
Very different. So revenue is, so year-to-date revenue is what you've recognized so far. ARR is your current MRR times 12.
Yeah.
So it's going to be higher, generally.
Which are in theory the same thing as of December 31st. In theory.
Oh, because only if you added so if you had no new customers added through the year.
Yeah.
And so you had no client activity other than the recurring revenue happening consistently, then they would be the same at year end. Otherwise, they're not going to be. Because annual revenue is your accumulation. It's your trailing 12 months of revenue, which it's been growing each month. So it's not 12 months, what your December MRR is. Anyway, we'll,
Yeah, okay, yeah,
it's,
because okay, because your ARR as of December 31st is really for the next 12 months.
correct.
Correct. Okay,
Yeah.
excellent.
And another way of calling that is run rate, like revenue run rate is like your ARR too.
Anyways, that's our little technical discussion while you guys are gone. And excellent.
Okay, so let's see, am I sharing now? ABC
Yeah, you
code?
are sharing. I can see it all, and we've got most people back, I think. Yeah.
Okay, so here's what we've got, folks. What I'm showing you here is what I like to use as like a projection, which has both the income statement. So this top section here shows our revenues and expenses. And then this bottom section is kind of a cheat sheet cash flow. So that on one page, we're able to see what's happening both from an operational performance standpoint, our revenues and expenses in the given month, and what's happening in cash. And they are not the same unless you're a business where like a restaurant would probably, they're going to recognize the revenue of the customers coming in, and their costs are pretty much happening in that contained period. So everything is sort of like the bottom line would be the change in cash for a business like that. But for investable businesses, it's often needs some different adjustments. But let's focus first on the top section here. And we've got in the revenues, I've broken it out, three categories you'll want to at least have. Your recurring revenue, your non-recurring revenue, NRR, actually has two meanings, but in the case of an income statement, it means non-recurring revenue. And then if you had discounts, you were giving discounts and credits, maybe, customer's unhappy and you're like, oh, I'll give you a coupon towards something in the future. Separate that out too, because that's part of some data that you're going to want to have. But if you don't separate it out, it's likely going to create some confusion and extra effort for your finance team. So from a revenue standpoint, you want to have those. You see here, I've got months. This is over, that's the key thing. It's forward focused. You probably want to create some subtotals for the year so you can show the growth. So in this instance, we've got 470,000 in revenue year one, and then we go up to 1.4. These are being fed by revenue forecasts that I've created here. This is a super simple thing that won't work for many businesses, but it from a principle standpoint, it helps you kind of think it through. So we've got, if you're today, what have you achieved from a recurring revenue standpoint? If you're at 20,000 today, then there's our starting point. How much do you want your MRR to grow month over month? If you have a subscription-based business, ideally you're growing it by 10% month over month, at a minimum of 10%. In the early days. As you get larger numbers, that may grind down, but those are good starting points. And how many months does a customer stay with you? So in this case, I've actually created a little bit of a cheat sheet in here where we've got the number of months. So I have asked some questions here where things can be plugged in to inform this number, but we've got 60 months. Our churn rate is 1.7%. And we've decided that in this case, the subscription price is $300. So this starts us at 20,000. That's what we said we had already achieved. We're churning $333. So this is the churn rate, 1.7. We expect to lose, obviously our price is $300. So we're not really it's not going to be accurate in a monthly basis, but over the course of a year, you're going to be within reason of a number. And then how much are we adding? We're adding 2,033. So we're growing. This is based on increasing our revenue by 10%. In this situation, because we priced our new customers at $300, we're saying this is on average 8 new customers. So $2,333 divided by 300 would be 8. So this is one way of projecting out what your revenue is going to be over those months. Gets us, this particular situation gets us up to 196,000 per month.
I'm just going to have you pause after you finished on this particular sheet. I don't want to interrupt what you're doing here, though.
No, I've got
but-
one here, what I just kind of highlighted is the triple, double, double, double. Did we?
Okay, yeah.
And just
Yeah.
a little, so yes.
Yeah, okay,
Okay.
great.
Yeah.
So Tally has a question because I've forgotten my question. I had a good one, but yes, Tally, go ahead. No, you're on mute, Tally.
Yeah, got it. Okay, my question is, how do you reflect MRR for products that are pay-as-you-go? So let's say it's a monthly fee, but you can cancel anytime. So they're not locked into a 12-month contract or a 36-month contract. How do I know what my MRR is? Is it based on churn, just like the average of how long they typically stay on for with that product until they delete, like they delete it or they cancel it, or is there some other more clever way to figure it out?
No, that is pretty much it. So let's say Netflix, right? We are all paying for Netflix, but we're not locked in. So we are a MRR client for Netflix. And the way that they would calculate the churn is with their historical data. So their MRR per customer data is going to show them how they're growing the new MRR and the churned MRR. And then if they change price, if there's pricing, they do have different pricing. So they might have expansion MRR and contraction MRR as customers move up and down. So you
Last
need,
time they boosted the prices, I'm sure their churn went up as well too. So
well, that's exactly it. That happens as well. So if you have that model, you want to make sure that you're tracking in your accounting software, ideally. So if you're using like QuickBooks Online, you want to have your revenue amount per customer per month tracked so that you have that data set. And then you'll be able to run the analysis on that to determine what the churn rate is. And then the churn rate determines the lifetime that the customer stays.
I guess the issue with me, and it might be too specific for the group, but it's really not like Netflix where it's just sort of, you know, the typical customer stays as long as the other typical customer. Like for my product, it's very unique. Some people might need it for 2 years, some people need it for 2 months, and there's no way to predict. It really just depends on their case. So is it still reasonable to use the churn rate?
just use your average, whatever the past history is what you're assuming for the future. Right?
Yeah, I think so. You'll get into cohort analysis. So like I'm thinking of a client that had they have a solution that sells into universities, it sells into research institutes, it sells into businesses, and it sells into students. Students tend to use it for a semester. So those customers that they're cheap, they only need a little bit of the solution. They stay 3-4 months, but they're using it early, and down the road, they may be in a corporate enterprise where they're the key buyer for it. So it makes sense for that company to have that customer base, but they churn out after 4 months. Their enterprise customers stay for 8 years. And so as you grow and your data grows, and you're going to need to at least hit 100,000 MRR before you're going to want to get into too much data analysis. It's going to be lumpy and bumpy and up until then. But once you get to a certain level, you're going to want to look at the segments, and you could do cohort analysis. So the lifetime of this cohort is 60 months. The lifetime of this cohort is 4 months. Do we even want to do anything for this 4-month cohort? Are they valuable? Why are we serving them? Is it like thinking through, not that it's always about money. A lot of our businesses here are impact businesses. So it may be the nature of the situation. If it's an ailment that you have for life, or you have for a few months that you need a solution for, there's just going to be differences about them. And so you can group them in cohorts and run the metrics distinctively.
And I wanted to ask too, Susan, just to go back to the worksheet, which will be available to everybody. Where am I putting that grant revenue again? I didn't see a line for.
Yeah, so
uh,
it would be in other income. So here on the left, these are little plus signs. You can either go up to
Yep.
1 and it expand, or 2 expands everything out. So here, just to walk everybody through, we've got our revenues, we've got our cost of goods sold. In this case, I've got just a simple one for hosting. Also recommend, generally speaking, if you're an innovative company that has any research and development, separate it all out. So you wouldn't have all your salaries in one bucket. You're going to separate out your salaries by, in this case, R&D. As you grow, if you start to hire people in customer success, like to work with your customers to ensure that customers stay, then that's a department. Sales and marketing, definitely you want to have that segment in it because it's how you calculate your CAC, cost of acquiring a customer. So all the sales and marketing costs, which would include advertising, Google ads, salaries, any commissions you pay to salespeople, all of that. And then everything else is kind of in general and admin. And generally you want your general and admin to be like less than 20% of your total spend. And that's where you get your legal, accounting, blah, blah, blah. Down here in the bottom, this is other income, other expenses. So other income here, we've got IRAP, OCE. Back in the day, we had SEBA. Thank God that's gone. Interest income. So grants would be in other income. And the reason why is because they're not operational. They're one-time things, and investors, any reader of your financial statement is going to say, well, they happen, but they're not something you can kind of count on year over year. And they're not really, it's not coming from your customer. So you typically keep them separate. It's relevant for overall business performance, leverage all the grants for sure. But that's where they go up.
And you did, does everybody know what shred is? Hands up. Everybody know what shred is? It sounds like it is. Okay. So you saw Jane noticed the line further up on shred,
Yep.
because it does apply to R&D costs, which is another reason why to keep those separate. And so it makes it easier for you in the future.
Absolutely. So a key thing, so it's sort of an exception because it's an investment tax credit, money coming back from the government for tax, sort of works like a grant. However, it's specific to development costs. And if you separate it out, you can set a tone of, for instance, your development costs are going to be higher because this is an offset. So in this case, we would have like salaries of 10,000, contractors of 5,000, and then your shred may be minus 2,000 because you're accumulating that an accrual up. And at the end of the year, you're going to submit your shred with your T2 filings to the government. You're going to get that cash back. So this is a way to recognize the amount of money that you're anticipating getting back from the government relative to the development work you did. And if you didn't do that development work, you wouldn't be able to accumulate this. So I've seen for companies that don't track it within the development department, I've seen decisions get made to cut development work without the consideration that it's going to also result in less shred money coming in. Those two need to be considered together. So this is the most common this recommendation for where
and Sandra, we answered your question earlier well enough by looking at this spreadsheet. Yes, okay, perfect. Thank you.
I also just want to show you some bells and features. So for staffing, this can be helpful. You put in the person's name, the position, the department, and then their salary. So you change those dates to be 2024 or whatever. You get, basically gives you 5 years. And then it cascades of the monthly amount. And down here, then you can have, so these are looking up above and you put whatever departments you want, and it will sum up for you the total cost of salary and the total head count. And then also estimate the benefits, so CPP, that kind of thing for them. Just much easier for founders to be able to load the costs in here, and a similar one for contractors. So this information here then feeds back over into the income statement. So in here, this development salaries is grabbing from the employees tab. So it's just done some legwork for you.
Now, you are going to be working with financial advisors over the next little bit. So, if you want to, get a better feel for this while you're working, that's a great way to do it, and make sure you fully understand all the power of this incredible worksheet. Good.
And okay, so let me go back to.
Okay, we're going to shift again, and we're going to talk a little bit now about,
Actually, shall I go to the metrics?
yeah, I thought that's, was the plan. Yeah.
Okay. Here's all the metrics, that, I mean, there's always more metrics, but these are the ones that commonly come up. EBITDA, path to profitability, runway, you can see them here. Let
I'm
me
not
go.
seeing things change right now, Susan.
Yeah,
I'm just on the, I'm in the PDF version of the deck.
Okay.
And you opened up something different, I think, that's all.
Interesting.
It didn't look like PowerPoint. I think you had PowerPoint the first time, didn't you?
Oh, so what happened to it? Interesting, because I was in. Let's see.
That looks good. Excellent.
Oh, there. Oh,
Excellent,
my
yeah.
apologies. This is exactly. Well, obviously I did something.
Yeah,
wrong.
we weren't seeing it yet. But, okay.
Okay. And okay, so I thought I misinterpreted your question around seeing. So let me just start to go through here. Month over month revenue growth and year over year revenue growth. That's a key thing that people are going to be looking for. It tends to look like capital M, small o, capital M, or capital Y, small o, capital Y, and a percentage at the end of it. For month over month revenue growth, 10%. Now, in recent years, the growth has been tempered with profitability. So 5 years ago, this presentation would not have had anything around profitability in it because it was not important. It didn't matter. It was growth at all cost. Since the last few years, investors are also looking for sustainability. So their profitability isn't very important. And so just keeping that in mind, you want to grow the revenues, you also have to keep in mind profitability. But when we're talking about revenue growth, you want to know what's your annual growth rate. How much did your revenue grow from last year? So if you're running everything through accounting software, which please do, it's time to get into an accounting software. QuickBooks Online is perfectly fine, not expensive. You can then run a report a year with comparison. So year to date with year to date last year and see what your growth rate is. The difference and the percentage is the amount. So that's important. There's two terms, net revenue rate and gross revenue rate, that you want to know. So this is the second NRR number. It's also known as net dollar retention. And it's measuring the revenue growth from your existing customers. So you look at the end of last year, how much revenue were you generating from your customers? Now, how much revenue are you generating just from those customers? And so you can't add any new customer revenue, and it isolates just for existing customers year over year. And you want that number to be north of 100%. 110, 120, 130. It's showing what it basically means is we retained our customers and they're paying us 20% more. And so if you didn't retain all your customers, which a lot of us don't, and this is, again, these are SaaS metrics, these are recurring revenue business metrics, but they're still valuable for any company to keep in mind that ideally you want to be growing your revenue per customer over time. And so this does not take into consideration any new customers. It's a really important metric once you start to have revenue data. Gross revenue rate is like a cousin to it, but you don't get to include upsell. So the most it can ever be is 100%.
Cheryl's got her hand up. I just want to add, though, I don't hear these terms at the angel investment stage. So, because any revenue is kind of what we're excited by a little bit, but so it is a later stage metric.
Yeah, reinforcing once again that with I mean, for angel money, you don't need a lot of this, but you have to have for your Series A, it's going to be very important. So your projections that are required to dictate how much money you need from your angel need to factor them in.
Yeah.
So it's getting comfortable with them, building out those projections, but you don't need them. You don't need to know these inside out for the angel round.
Okay, we have Cheryl and then Tally with questions.
Yeah, I think this might be more a question for Julia and like SheBoot specifically, but is also very relevant to this conversation. So we just went through a huge pivot. We started off as an apparel company selling D2C like product, and now we're a tech company who like is essentially like starting from zero. So we have like none of these. We can't show year over year or even month over month because we've literally just started selling tech. So I'm just wondering like that like would I just focus on projections then, Julia?
Yes. Yeah. I mean, that's all you have to work with. And being able to sort of establish the pricing and do the bottoms up, I think will be an important part of that as well too. But what's great is Canadian investors don't like D2C, so it's
which is why we're now a tech company. And also, I like by the time we get to like end of program, we will have like some monthly revenue. So that's good to know.
Well, and testimonials. I mean, all traction does not always mean just revenue. So testimonials, LOIs, just anything that's proving that you have people, just trying to pull your product through faster so they can get it in their hands is fabulous. Tally.
Hi. Okay. It's interesting the different perspective between the angels and the Series A people. The ones that we're going to be pitching to throughout the program and then at SAS North, are those like angels, or should we be tailoring our pitches to angels or the Series A?
Yes. I mean, yes and no. So our goal is, and the SheBoot investor group is angels. I have women in there that have never invested in the past investing. I have veterans also. So it's a very distributed group of 30 women that are here to support women, entrepreneurs. So that's who you'll be pitching to on October 28th. When we take you to SAS North, the very first thing we're going to do before we take you there is we're going to have you and support you in creating a 3-minute version of the pitch. So the pitch for the 28th of October is a 12-minute pitch we're suggesting, because that's a typical angel pitch length. But 3 minutes will be what you'll be using at the gala as I call it, launch you to the greater world. And then you'll have the opportunity, and our goal is to connect you up with as many VCs or other angels as possible to either close your current round or start the conversation with a VC that you captured their attention, and they're going to watch you for the next 12 months and offer you nothing other than advice for a period of time, but watch you grow. And so it's a good way to start that next relationship. Okay.
Yeah, and I just want to add to that, like, I want to ensure everybody has the confidence to know you don't have to know your numbers inside and out for the angel raise. And projections are important for everybody. So historical data is not necessarily important for everybody. If you have substantial revenue that you've generated, then you've got some data that to mine to be able to share some information. But everybody has projections that will be valuable in it's sort of like pool. You want to line up your second shot. Like I've never been good at that. If I get the ball in one, yeah. we've got to consider where that ball should be placed to get that next shot.
Mhm.
So I would say, does everybody have to do a Series A? Not necessarily, but give that some thought. Are you
Yeah.
gonna, is angel money enough for you to get your company to the point where then you can use non-dilutive debt? So for instance, if the angel money is enough that you can launch and you can become profitable, then you can probably borrow money from BDC in order to grow your business. And you may be able to use that kind of money, loans, in order to grow it enough to be able to pay back the angel investors with a healthy return. That can work for some of you. So you'll want to be aware of whether you can do that. If that's not going to be possible, because no, you're going to need to raise, an additional $5 million eventually, then the sooner you're thinking that, like, that has to get into those projections, and you'll find yourself speaking about elements in current conversations that you're building into that 3-year plan. So that's where the value of that, and people, when they're asking you questions, the seasoned investors will be listening to your answers with those metrics in mind. So you're only placing assumptions. You don't have the data. It hasn't happened yet, but this is what you've planned out.
And I do want to, since we talked about historical revenues versus future revenues, one of the things that you may be in a situation of is that you've been doing a lot of what I call service-based revenues, custom work, direct with a customer, and now you've made the decision to build your product. In that, you have to split those revenues out so that you can properly show investors that this is the service revenue of the past, but now we've got a separate line that shows that product growth, and we are focused on product going forward. If you don't do that, they're going to feel like you hid something. I've seen it happen, and they really want to see, if you're trying to sell your company based on a product, make sure that you've separated out that revenue rather than obscure it in the midst of a whole bunch of other revenue.
It's a good point, Julia. There's in the form of recurring revenue, there could be recurring service revenue and recurring product revenue.
Yes,
So
sorry.
we'll
Yes.
want to separate those out. They can totally, like, service revenue is recurring revenue as well, but the costs associated with it are going to be different. If it's service revenue, you have to have people likely performing a service. So you're going to have a cost associated with that, and your margin's going to be lower. So yes, separating out your non-recurring revenue and then separating out your service from your product revenue. You don't need a huge number. You don't need to have every product on your income statement separated out. That's not required, but just these categories are important. Also, what's important as you're building out your projections is keeping in mind LTV to CAC. So lifetime value of a customer, if you're going to make $3 over the life of a customer, you want to spend no more than $1. It's a 3-to-1 minimum ratio that you're looking for. And how do you calculate CAC, which is cost of acquiring a customer? It's the total sales and marketing spend divided by the number of new customers that you added. And it doesn't matter the period. So in a particular period. So if it's over the course of, if you want to know what was my CAC last year, well, you can look at how many customers did you acquire and how much money did you spend to acquire those customers? How much did you spend on sales and marketing? In early days, it's founders usually making the phone call, so you may not even have those costs. But as you're building out your projections, here's my sales and marketing spend that I think I need. If you think through that customer journey, I'm going to need to go to trade shows, then I'm going to need to do call outs, then we're going to need to do Google campaigns, then we're going to need to, all the different costs, and what are my assumptions of the number of customers I'm adding each month. And then you have the math. Sales and marketing spend for the next year, number of customers added next year, divide the sales and marketing by the number of new customers I'm planning to add. That's my planned CAC. And then what's the lifetime value of the customer? What's my average revenue the customer's paying me? What's my gross margin associated with that? If it's a product company, it's going to be 85% and above. If it's a service company, it's probably more like 50%. So you have to factor in your gross margin and then the number of months a customer will be with you. If you have no revenue you have today, then you're speculating. How long do I think they'll be with me? If it's 2 months, 2 months it is. So if it's 2 months and they're paying you $1,000 a month and you have a 50% gross margin, it's $1,000 minus 50% gives you $500 for that month times 2 months, gives you $1,000. Your lifetime value of that customer is $1,000 in that situation. And you compare those two things. So that's what LTV to CAC is all about. You build out, I would say with these, like what I tell clients is, let's build out your financial plan, then I'll run the metrics. Talk through your reason. What's my strategy to acquire these customers? Let's make sure I'm building enough cost into this to have enough to be able to do it, and then look at the metrics. The other factor is payback period. You want to ensure that when you acquire a customer, the value of them is going to be, you're going to be pay it off the cost of adding that customer within 12 months. So that is another formula. So payback period, just so you know. Again, you'll have to build out your projections, and then the financial advisor should be able to help you calculate these if you get to a point where you actually have your projections completed in the boot camp. And if you don't, and you have all the information to be able to do that after, great too.
So Susan, I think, yeah, we probably have 5 minutes left, and then Katie needs 5 minutes. So financial, I would go to the checklist, actually, your due diligence checklist. Let's run through that real quick and round out what we're talking about here.
Sounds, apologies there.
And continually reinforce this due diligence stage.
Yes.
One more, yeah, there, yeah.
Too far.
Okay.
Okay, so here are, when you're asked to fill up the data room, this is generally what you're going to be asked to provide. So financial statements, so you're going to look at what you had last year. So get an accountant, make sure you have an accountant who's filing your income taxes and putting in, doing your financials, which again, compilation engagement is fine until somebody asks you for something different. So it's your year ends and it's your year to dates. Year to dates can really just come from QuickBooks. If you're raising money, you need a good, sophisticated finance team. I'm going to tell you, you should spend 5% of your total spend should go to finance and accounting. That includes your tax filing. So keep in mind 5%, setting that stage for you. Income tax returns, because they want to know that you're in compliant, that you've got confirmation, confirmation from your auditor accountant around that. HST return, so you have to be up to date with your HST. And so make sure that's taken care of.
Can I just suggest, Susan, that they, this is the same list they've seen. I mean, it's in a different format, but it matches the SheBoot list. So if you have any questions on that list, let us know. Or you want to ask a question about that, but it's about the same as you've been seeing.
And my data room tips are pretty straightforward too. I just generally say, so in the SheBoot program, it's Google Drive where you're going to be loading everything into. For others, you may want to have a Dropbox. Sometimes if you're talking to a number of angels, the one Dropbox is often, because everybody uses something different, one that's the most generic. That's why I usually say it as a tip. I wouldn't combine different angels into one box because they'll be asking questions. So again, you can have one for SheBoot, but if you're talking to other angels as well, make sure you do a separate data room, load in the same document so that as they ask you stuff and you continue to drop the files in there. Otherwise it gets a little hairy. But I want to give you time for questions. So
yeah, and there is one from Tally already. You said 5% of what for the tax and accounting costs? 5% of your total spend.
So if your spend when you look at your annual spend, when you create your financial plan, because nobody's like, who knows how much is a reasonable amount? 5% of your total spends for the year. So if you have like a plan that has you spending $1 million, 5% of that $1 million would be the reasonable budget that would go towards, you're going to need bookkeeping. Bookkeeping is processing your payroll, helping you with the invoicing, reconciling your bank accounts. Controller is generating reports, ensuring that your books are GAAP compliant, because chances are they're not at the bookkeeper level. You need to make some adjustments to recognizing revenue and expenses in the appropriate period. And then the CFO helping with projections. So the cost of it scales as your business scales, because the complexity of what's happening scales. So 5%, so 20% covers all your G&A costs. Inside that 20%, a portion of it is finance and accounting. So it's not G&A 20% plus 5%. It's 15% to everything other than finance and accounting. And that's, that's how you know you're within plan. Sometimes people are like, oh, I think I can get this for $200 a month. You're not going to get quality. So keep that in mind, just as a reasonable number to plan with.
Excellent.
Wonderful. Great note to conclude on. Thank you so much, Susan. This was, I mean, the feedback in the chat has been fabulous. And to the founders for being so interactive. And of course, Julia participating, being able to share the angel perspective and the founder perspective yourself. I hope everyone got so much out of this session. And there's a couple questions about Circle and getting active in the chat in Circle and having a presence there. Absolutely beautiful place to start. Cheryl already being an awesome champion and also inviting folks to participate in co-working sessions, which I love. But yeah, before I hop into sorry, Tally, did you have great feedback. Already getting great feedback, Susan. But and there's a feedback form, so yeah, go ahead.
Back to and I realize I'm sending a direct message instead of to the group. Did confidence increase from the start of this? Did you move the dial a little? I can't see people, but hopefully.
Yeah, you got two thumbs up, and almost everybody's got at least a thumbs up. Yeah.
Love it. That's the number one. That's the number one goal set out at the front, and I think you delivered, Susan. So thank you so much. And I know we only have a couple more minutes, so I'm going to go through very quickly next steps, and then I'll let you all leave. But please, you can follow up with anything, and we'll make sure to manage any questions that come through, or any concerns that you have. So to start, log into Circle. Already delivered that message in the chat. So log into Circle, make sure to introduce yourself, and it's a perfect place to connect with one another and us. Workshop prep. So we do have our workshop next Tuesday. For those, there are very different personalities that always enter a cohort, and some love to have a clear idea of what's to come and an overview of the session. So we make sure that those are available. I'll both be adding that to Circle in addition to it's always can be found ahead of the workshops in the founder share folder. So get used to visiting that regularly. We have our 12-minute pitch, first time delivering that tomorrow, but we're doing it in peer practice sessions. So it's going to be our group together. We're going to be practicing our pitch, going through and setting expectations of what's to come the weeks following. So it should be it's going to be an extremely interactive session. Just come prepared with your deck and your 12-minute pitch. We'll be doing advisor introductions, so just watch your inbox for that. Just a quick note, we'll introduce you over email, but our advisor hours are really up for you to access. So it's a self-serve is what we say. So when you need, you're recognizing that you need to speak to a lawyer or you need to speak to a financial expert, that's whenever you can reach out, and we'll make sure that you're connected, but connect at your own pace or when need be. Also, have conversations with your coaches. They're there to help you, and they're going to be well informed on what advisors you have access to through the program. So just make sure that communication with your coach is there too, and they can help you through that process. I also want to flag, does everyone know, can we get hands up? We're all coming together in Ottawa, November 11th to November 14th. Yes, or November 12th to November 14th. Beautiful. So I just wanted to put that on everybody's radar. We're going to have our grand finale event and then, of course, participate at SAS North. There's going to be more information that comes through, but I'll be providing a 1-pager or 2-pager guide of just exactly what actions you need to take to make sure that that trip, you've got, if for those who are traveling, have the hotel booked, their flight booked, and what it looks like for reimbursement and what will be included over those date periods and what you can expect to come. So that's just coming through your inbox, but I just want to make sure everyone's on the same page that we're going to be getting together. It's the best part of the program. So I'm already counting down the days. So based on what I've covered so far, is there any questions that anybody has? Just feel free. I can't see the chat right now, but feel free to just pop off mute and ask.
And we do a group pic, somebody said, which is a great idea.
Oh, a group picture.
Yeah.
I just
Yeah,
want to know what the timing for tomorrow. It's 10 to 11, or is it longer? The pitch for tomorrow.
The pitch for tomorrow is scheduled for so each of you have been divided into 2 groups. So
Okay.
you'll see it in your calendar the length of time. I've allotted an hour and a half, and the reason it looks differently is because, of course, we're just going to have a brief introduction, then we're going to have a chance to pitch. It shouldn't be the full hour and a half, but just to make sure that your schedules are blocked and we don't run over time. And it's just so that we're setting the tone that you know what to expect for the weeks to come. The weeks to come will operate in more of a very structured fashion, where this time we get a little bit more chance to relax, chat, talk, and get to know one another. So that's why the tone is a little bit different, where in the weeks following it will really be strictly timed, and then you'll only have the allotted amount, and then we'll move to the next pitch, and then we'll all say goodbye. That makes sense? Any other questions? No? Okay, beautiful. Okay, I'm gonna do a screen grab. So everybody ready to take a picture? Smile. Perfect. Okay,
Excellent.
and with that, Julia, do you have anything to add before we head out?
No. Great spending time with you. I'll see you again next week, I think. Yeah. Take care.
Perfect.
Bye.
Bye, everyone.